at the foundation of everything we do at IBD is looking at the past and learning from it. And that we just are carrying that on from Bill O'Neill, the founder, who that's what he was doing back in the 60s. He decided that he really wanted to be the best at picking growth stocks, and he was. And how he did that was just studying history and looking at prior leading stocks that had had huge moves. Um, and then just tracing it back to the very beginning of the move and looking at what did that stock look like before it had its huge advance. So the inflection point, which what we call the pivot point out of its first base. You would look at that both on the fundamentals, so the earnings, the sales, return on equity, all of that good stuff, as well as what did the chart look like? What base formation did it come out of, and how did it come out of that? Then he would trace it out to the very top when that move was over and study that portion and see what clues were there to recognize, okay, when does a stock top? And what he found is they will top based off the technicals, not the fundamentals. So we buy using both a blend of fundamentals, technicals, as well as the group, as well as what the market is doing. But really, fundamentals and technicals are the core part. And then we sell based on what the chart is actually doing. What are the technicals doing? So let's go out to
Honestly,
October of 1998 on Schwab. You could easily spend a couple hours or maybe 3 hours going over, and we're just going to have to do this, a short little bit on it. And let's go to the weekly chart on this. So this is a beautiful, beautiful cup with handle. And that's, Bill might not use those exact words, but he used to say how great this cup with the handle was. And frankly, I could not see that at first. To me, it looked like a bad double bottom. Let's zoom in, just zoom in massively, just so we just see that most recent base. So this last little cup with handle, that is picture perfect. And it turn off pattern rec, because when you see the pattern on there, it becomes obvious. But just imagine looking at that without the pattern and then thinking that that is a beautiful base. Um, it it takes a while to realize how beautiful this is, and it is picture perfect. At the same time, you always want to play three-dimensional chess, so you need to look at what the market is doing at the same time. So pull up the NASDAQ. We were going through a very sharp 33% bear market. I remember that like it was yesterday, extremely volatile. And look at those low points there of the double bottom in there. Now, focus your eyes there. Now, what is the date of that bottom week?
and 9.
Okay, now let's go back over to Schwab and see what was going on there. So at the same time, the market was hitting two bottoms. This one was hitting a higher bottom. Major divergence. That is basically all you need to know about this, is that when you're going through a bear market and you have multiple bottoms, which stocks are hitting higher lows while the market is hitting lower lows. That is your biggest tell that you'll ever see. Everything else is just small compared to that. So now you look at the base structure itself of what was it doing in that cup with handle, and you would do, we don't have the time for it, but you would do a week by week analysis looking at the price and the volume, as well as the closing range, what the spreads were, which ones had the biggest spreads, the smallest spreads, the biggest volume, the smallest volume in the base, and you really let it tell a story. But we'll focus in on two key weeks in there. The bottom week, what is your closing range on there?
47%.
47. So that's saying if it closed at the top, it would be 100, the bottom 0. And the key on a weekly chart, or really any chart, is 40% or higher when it's coming down. That actually turns it from a red week into something different, not red or blue, but supporting action or
Right.
accumulation. So that was your key. It was getting accumulated. Now, if that would have closed in the lower part, sometimes Bill would go down to 38%. The two of us did spent years trying to refine this week by week analysis and really codify it. We never finished it. I hope to dust that off and finish it someday. It would be a lot of fun. But anyways, you look at those key things. So that was a big positive. Go out 2 weeks from there, the week that it goes through your 40 week. So as you go through key levels in a chart, whether it's an area of resistance, as something falls through support, you want to really pay close attention to it. And it is, of course, going through a 40-week line is a big deal. That's your 200-day. And so when it does it, you want to see, does it just like gradually go through there, or do you have power? Tons of power. That means shorts are getting squeezed. That's a good thing. There's power there, but then it came back down because the overall market came back down, but it held up. And what was the closing range on that handle week?
95%.
95. Doesn't get much better than that. So that's just textbook quality setup, and you really want to get this ingrained in your mind. And when I was building Pattern Rec the first time, it took me over a decade to build it. This was one of the ones that I focused in on. I wanted to make sure that no matter what I did with that code, that it got Schwab as well as some other key ones. So now you have your classic setup. Now the rest of it then becomes easy. On a relative basis, so you know that you're dealing with qualities. And I will say, Bill was buying this in large amounts, both this and AOL during this time, and he pretty much top ticked both of them. About as impressive as it gets. The only thing better were, really is his Amgen trade was earlier in that decade, but so impressed. So anyways, you get this solid breakout. And what I've studied all of Bill's stuff probably more than anyone alive. And the one thing that's unique that in pretty much all of his big winners was it didn't test him for the first 8 weeks. And on a daily chart, let's toggle over to the daily. There were tests for someone like me that trades a little faster. But if you looked at it on a weekly, there weren't those tests. So that's the advantage of leaning heavy on a weekly. That these wiggles and wobbles on the daily, they don't show up there as much on the weekly. So it wasn't, when you're dealing with a high quality stock coming out of a bear market the way this was, you're gonna expect wiggles and wobbles to come in there. And so you got to put on your position trading hat, not your swing trading hat, because you're likely to get chopped up if you're trying to swing trade this. So what was unique for him about his big winners is early on, let's go out maybe a month. They had decent gains, so he had a cushion. And what he would do is anything that was working for him as it's moving up, he would just keep force feeding. He would sell his ones that are either he's down on or that weren't performing as well, and just move that money and just keep moving it in pyramiding into the one that's working. And all the ones, they didn't test them early on. I mean, that's really the secret sauce to Bill's biggest trades, is not getting dislodged in that early little, maybe call it 8 to 13 weeks of the move. So we're out here, we're a little bit shy of 8 weeks out of that breakout. It's holding your 21 day. So the way I'm looking at this now is saying, all right, the 21 day is that green line is very important for this stock. Now the ones that don't hold it, then you look for something else that it holds. Maybe it holds the 50 day. So let's go out another month. Let's just do this 1 month at a time. If I had my way, we do it every day. But let's go back a week, just because as it moves up, things kind of get compressed. So again, it's holding in there, and I just want you to focus in on how it handles the 21 day. Now, you're looking for a material break of the 21 day, not something you'd put in a spreadsheet and have it be like 2 pennies underneath it. Really, is it holding it in spirit or not? And so far, it's completely holding it in spirit. So now we can go out a couple more weeks. It looks like climax action, not climax top. And there's a difference, and the difference is in time. So go to the weekly for a second, because it's a little bit easier to see there. When you have a climax type of action, but it's this early on, you can see in the top right-hand corner where we've got Pattern Rec telling you it's 95% in 12 weeks. 12 weeks is too soon for a classic climax top. They typically happen, 16, 18 weeks or longer. Bill would typically be adamant about 18 weeks or so, but the reality is it's just not early on. And so you want to keep that in mind, just saying, yeah, you could sell some into this, but you don't think it's the ultimate top there because it's so early. But you never know. It could be. So let's go back to the daily because it certainly has the climax top characteristics going on there where you get this acceleration out of the normal move. And so it's climax type of action, which you can sell some, but it's still holding that 21 day, obviously. So let's go out to the end of January. Again, it's just digesting itself around the 21 day, and one thing that we've talked about on prior ones is my quicksand Grateful Dead rules that are around the RS line, that green line there, and those moving averages. Is it holding above that or not? And it's been holding above that. So you've got two things working for you, holding above your 21 day, as well as your RS line holding above its moving averages. So that's keeping us in. And all we're doing is trying to find ways to add to it. And you can see when it went up to that 68.50, the normal and natural reaction was to come down and test the 21 day. And it passed that with flying colors. And frankly, that's the day, an upside reversal at the 21 day where you want to gas that, and if you sold into that, that climax action, you want to be buying those shares back and probably more using that low as your stop. And let's go out another month. So again, it's just digesting this gain and it's holding in and around that 21 day. So it's key there that first true break of your 21 day wasn't a decisive break. And why do I say that? We're the day after, yeah, that day there, because you had tested it 2 days before and had an upside reversal there. So now you're coming back and just going underneath the line. A decisive break would have been a close under that 60, 69. So that's more of an art than the science. And you can see it keeps on testing it and testing it. Let's go out one more month. And that RS line is holding nicely. Now you've got this acceleration type of feel. Let's toggle over to the weekly to get a sense of what's going on there. And it's just inching up. And this is a perfect stock for a Bill O'Neill because it's holding that 10-week line, that red line. And that's what he would be focused in on. He wasn't using the RS line moving averages or the 21 day. He'd be looking at that. He'd be looking at it on an intraday basis and a daily, but he would be leaning heavily on that weekly saying, is it doing anything abnormal? Well, he didn't necessarily use that terminology, but that's what he would be after. Is it doing anything wrong? And it's not. It's still a clear leader in the market. And let's go back over to the daily and let's go out one more month. Okay, so here it had its climax top, but let's go out to the top day on there and do a change date. And I was double checking with Justin ahead of the show to make sure I was remembering it right because he had access to all of Bill's trades and everything. And yeah, Bill sold this, in and around the top, this and AOL, pretty much top ticked it because he was using his climax top rules that you can find in one of the greatest books ever written, How to Make Money in Stocks by Bill. And in there, it just lays out all the rules. But I'm going to just tell you the cold hard facts of the rules. They trigger a lot more often than you'd think. I had programmed into a pattern rec code that I never released all those things that are in there, and it had it show up on the chart of any time it's triggering, those rules. He'd have it, it's up 7 out of 8 days. It's extended, X amount from its moving averages. Just go to the book and you'll see all the things. And then I would have a number on there of how many times that triggered. Was it all of those, some of those? And when you see that along the way, lots of stocks will trigger climax top rules. So it is an art, not a science. So we'll try to make it eventually a science, but it is really more of an art than what those rules are. And you've got to look at it and say, is this doing something really abnormal or not? And you can see it more on a weekly. Let's go toggle over there because that's a log chart and that's extreme, right? And that is way stocks will top with climaxes. It will look like that. What would be normal and natural after that? At least some more pain, like going down more and then maybe dueling around, because there are stocks that have climax tops and then they go on to move higher. Axon is one of those. and we're studying back in the 2003, 2004 timeframe. So this one looks like a climax top on a weekly. Bill clearly recognized that, sold into that strength. Now let's go on a daily and see it all a different way, because you really want to blend both defensive and offensive selling, because if you sell everything on what you think is a climax and you lose your total position and then it keeps going higher, again, go and study Axon, that is a really difficult thing to ever get your position back. So Bill would say sell everything into that. I would say sell a lot into that and then look for other sell signals. So sell offensively as well as mix the defensively. So let's go day by day and see when it triggers that 21 day. Still above it, still above it. Okay, there. So there's a big difference. He was getting around 150, and this is around 100. That's why you want to blend the two and sell some up there and some down there, because if that had gone up to 300 and you had none in there, that's the other risk, is selling everything into what you think is a climax top that ends up going higher. And you can also see that RS line is going through its moving average for the first time. And let's go out a couple more days. Now, at this point, you're thinking, okay, if this has a chance of coming back, it's got to do a 50% retracement from that low, from that high and that low, and then start trading in the northern hemisphere, which would be, up there. So let's see if that happens. Let's just go out a week. Gets up about 50% retracement, normal and natural. So recognizing that, like, let's say that you hadn't sold everything, once it starts fading up around that 50% retracement, you could you could start selling the rest of it in there. And that's how I would be hoping that I would do it. Now let's go out another week. Now go out one more week. And you can see it's living underneath the 21 day. And go out another month. This is some people would look at this and say it's holding the 50 day. There's nothing wrong with that. Say, okay, it was maybe they call it climax action, and it was holding the 50 day, and then ultimately on that second day where it broke the 50 day, those folks would have to sell. And there's nothing wrong with that. It's what style are you trading? Our good friend Jim Ropel likes to use the 50 day and kind of a buffer underneath that of selling. And I could see if he hadn't sold in a climax, he would be selling there. And I think that's the right way of approaching it as well. And you can see that RS line is now underneath its longer term moving average. So we would have had the quicksand, Grateful Dead sell signals there. So it's not always just one thing. So we had our climax top, we had our breakup, our change in character, where you can just see those wild days on the way down. We hadn't had anything like that before. Break your 21 day decisively, the 50% retracement, it doesn't pass that test, ultimately breaks its 50 day. And go to the weekly on that. And let's just go out 1 year from there. And look, it's never the same. It's a completely different character. And you can tell that by the RS line and its moving averages. It's no longer, above there. And let's just go out to the current day. And you can see it never was that same stock that was before. And if you fall in love with the fundamentals and fall in love with the CEO or whatever, and you just want to hold for the long term, the way some people have made that work, like Warren Buffett, one of the best investors that'll ever live, would be able to withstand something like that. But that's not our style. So again, you just want to find the style that works for you. And I would suggest that everyone go and do this as a homework assignment. Go through this and play it 1 day at a time and ask yourself the rules that you use. What would you be doing in there? And there's no right or wrong. It's just what works for you. And then when you're done with that, test those same rules out on another stock and another stock. And then that's how you get better. And that Bill was getting better and doing that. We were studying models, until he retired, and that's something that we were always doing. And this came out of the first model book that I built, with Chuck and Ross back in, the 97 to the 2000 timeframe, which we referred to as the bubble book, because that was the bubble in the stock market. And until recently, I've said, don't ever look at those charts again, because those charts, it was so unique that you were in this wild and crazy time that those aren't going to come into play. Now, that's all I'm doing is focusing in on the late 90s, because it feels like we're in that environment with a whole AI. So I'm dusting off that, 97, really 1995 to 2000 models, and looking at those. And I suggest everyone else do that as well.